Hi students, welcome to my class Accountancy Simplified. In today's class, I shall discuss the concept adjustment entries once again. As in the earlier class, I have discussed only 4 types of adjustment entries. In today's class, I shall discuss some other important aspects of adjustment entries which are very important for your exam and for having sound knowledge on accountancy. The first item will be closing stock. What is closing stock? Closing stock is the amount of goods which remain unsold at the end of a given period or on the date of balance sheet. Goods which are purchased throughout the year is not sold in full. Some percentage of goods remain unsold on the date of balance sheet, and that amount of unsold goods is called closing stock. Closing stock generally do not appear in trial balance. As purchase account, which is the source of closing stock, itself appear in trial balance. So, until unless purchase account is adjusted at the time of preparation of trial balance, closing stock cannot be disclosed in trial balance. And you all know, closing stock is valued on the conservative concept of accountancy on as cost price or market price, whichever is lower. So, closing stock is not valued at the time of preparation of trial balance. It is brought into the books at the time of preparation of annual accounts. What is done? Closing stock is valued on the basis of cost price or market price, whichever is lower, and the value as determined is brought in the books of accounts with the help of the journal entry closing stock account debit to trading account. Why trading account is created? Trading account is created only to adjust its purchase and to bring a parity between purchase and sales to ascertain correct gross profit or loss. One point students should remember that under downloaded system, at least 2 accounts are needed to complete a journal entry. So there are 2 aspects. So at the time of adjustment entries in the annual accounts and balance sheet, we should keep in mind that we should either debit trading account and balance sheet, or PL account and balance sheet, or trading account and PL account. If we do not record the adjustment entries, both sides, either in trading and balance sheet, or PL and balance sheet, or trading and PL, the balance sheet will not agree. So, closing stock will once be appeared in trading account, and the same value will be appeared in the asset side of balance sheet under the head current assets. The next item is depreciation. What is depreciation? Depreciation is the annual normal wear and tear of every fixed assets excepting land. Every fixed assets like building, plant and machinery, furniture and fixture, air conditioners, computer, motor car, etc. are depreciated on the date of balance sheet each year. The journal entry is depreciation may be defined as a process of allocating the net asset value of each and every asset over its useful life. The allocated amount of each asset is charged to revenue account each year at the time of preparation of annual accounts. The journal entry is depreciation account debit to respective asset account. Depreciation is a loss, and you all know losses and expenses are debit, and so we should debit depreciation account, and as a result of depreciation the value of assets get decreased, so we should credit respective asset account. What we will do in the annual accounts, we should disclose the depreciation account in the debit side of PL account, and also deduct the value of depreciation from the respective asset account in the asset side under the head fixed assets to complete the cycle of double entry system. The next item is provision for bad debt. It is the estimated amount of money that may not be realized from debtors. We all, from experience, it is seen that a percentage of debtors do not pay their dues, and that unrealized amount is treated as bad debt in books of accounts. So, what the trader does, the percentage of debtors is set aside out of profit to take care of future bad debt. The journal entry is profit and loss account debit to provisional bad debt. We should debit profit and loss account with the value of provision for bad debt and credit provision for bad debt account, and deduct the same value of the provision for bad debt from the sundry debtors under the head current assets in the balance sheet. To complete the cycle of double entry, we should first debit the PL account with to depreciation on respective asset with the value as determined, and credit and deduct the value of that depreciation from the fixed assets in the in balance sheet under the head fixed assets. The next item is abnormal loss. Goods or stock lost on account of national calamity or accident is called abnormal loss in accounting. The abnormal loss is not treated as ordinary loss or business loss, and that's why gross profit is not disturbed due to the abnormal loss. We all know all the traders and businessmen insure their stock with the insurance company. So a certain percentage of the loss of stock is compensated by the insurance company. What we should do, we should debit insurance abnormal loss account with the value as determined and credit trading account. And then we should see what is the amount of compensation given by the insurance company. If the value of stock lost is 10,000 and insurance company is admitted the claim of rupees 8,000, the loss is only 2,000. We should debit insurance claim account 8,000, debit PL account 2,000 and credit abnormal loss account. So this is all about the adjustment entries. So before I close my class, I should once again request all my listeners, followers and students to subscribe my channel, like and share my channel for better circulation among the students of commerce. Thank you. Goodbye.